Hello, everyone. Today, we're going to talk a little bit about 1031 exchanges for vacation rentals. A lot of people call them Airbnbs, VRBOs. Those are nothing more than the companies where you can list and rent your short term rentals. But what is actually allowed for this to happen? Well, if you happen to own a short term rental, the chances are that you may have heard somebody say, hey, maybe you should try that thing called 1031 exchange. That sounds too good to be true, right? But what is that fancy terminology? It basically means that when you sell your property, you can simply reinvest the gains, that money, and don't have to pay capital gain taxes as long as you have reinvested that money into another property of equal or greater value. But we'll talk about the details about that later. It's almost like having free money, right? So, but if you Google it, you will find yourself probably buried into various different IRS rules, the whole concept of personal use limits and safe harbors, and a whole confusing tax language that you may not understand. So the big question really becomes, can you actually do 31 exchanges on vacation rentals? The short answer is yes, but only if you do it the right way. There's always a but, right? So today I'm just going to try to break it down in very plain English so you know what is allowed, maybe some of the risk, and how to avoid blowing up a perfectly good tax strategy, which a lot of real estate investors have been using for years. And I hope that you can get some benefits from this lesson today. What is 1031 exchange, and what is it that we need to do to avoid the whole IRS headache when it comes to that? At its core, 1031 exchange lets you sell an investment property and roll those profits into another investment property of equal or greater value without paying capital gain taxes right away. Basically, you defer them. Instead of giving that chunk of your profit of that sale to the IRS, you keep that money working for you for your next deals, I would say. And you can do that as many times as you want by fulfilling the requirements of 1031 exchange. Think of it like avoiding taxes forever, or more like deferring them while you grow your real estate portfolio. It really is that simple. So, but here's the most important rule, and everything flows from this. The property must be an investment real estate property. Not just your personal home, not your second home, and definitely not one of those we use it whenever we want beach type of home. Definitely not. So, do short-term rentals qualified as investment property? That's a question. This is where people get it confused. The answer is yes. Short-term rentals can qualify for 1031 exchange as long as they run like a real business that is intended to be. What does that mean? You rent it consistently, you charge market rates, and you treat it like an income-producing asset as it's intended to be. Your property is booked, marketed, and priced at market rates, and clearly intended to generate income. It's that simple. This way, the IRS generally sees it as an investment property. The problem isn't the short-term rental. The problem usually becomes when people use it as personal use and violate the rules. So let's define personal use a little bit more. This is where the mistake that gets owners in trouble, I would say, most of the time. You can use or you can stay in your home, vacation home, sometimes. Absolutely, you can. But there are strict limits, and that you should be aware what those are. To stay 1031 eligible, your personal use usually needs to be no more than 14 days per year, or no more than 10% of the days it's rented at a fair market value, whichever is greater. Why does this matter? Because the IRS wants proof that that this is basically an investment first and not your second home, with just a little rental income that you just got going on the side. It's that simple. And here's something important. This personal use limits that I'm just sharing with you applies nationwide. It doesn't matter whether your short-term rental is in Colorado, California, it is going to be applied everywhere. This is a federal tax law, not necessarily specific to a state. So please be aware of that. If you cross that line and the property, you violate some of those rules, I can tell you that your property may be reclassified as personal use. And once that happens, the 1031 exchange is off the table. You definitely don't want to do that, okay? Now let's talk about the IRS being a safe harbor rules for vacation rentals. What is that? Now, technically, a tax code doesn't really have a section called short-term rental 1031 exchange or Airbnb 1031 exchange, but the IRS did create a safe harbor guidelines, I should say, that give investors the clarity and protection that is required. If you stay within these guidelines, the IRS is very unlikely, I would say, to challenge your exchanges on 1031 exchange. For the properties that you're selling, here is what you need to consider. You must own it for at least 24 months, rent it at a fair market value for at least 14 days per year, and your personal use, you stay within the allowable limits which I just shared right before. If you're selling, if your property, if it is for the property that you are buying, I would say, it's the same concept. You rent it at market rates, you limit your use, and you hold it for investment. It's that simple. So safe harbors doesn't mean it is only the way to qualify, but for sure it's the cleanest and safest path that you should always try to follow. What if you only rent part of the year? What does that mean? Well, this comes up a lot in seasonal markets, for example, which beach towns, ski towns, or resort areas. The good news is seasonal rentals are also perfectly fine. What matters is that you intend to hold the property for investment purposes. You actually rent it when the season allows you to do so, and you document everything. IRS loves paper trail, right? So let's consider that. Even if it is only booked during peak months, as long as you generally treat it as a rental, it can still qualify to 1031 exchange. It really is that simple. So another question, can you convert a personal vacation home into a 1031 exchange property? The answer is yes. But this is where people need to truly work out. You can't just decide from one day to another to convert your vacation home into an investment property and sell it the next month. The IRS is always going to be looking at intent. Intent needs paper trail. So that usually means taking it off your personal calendars, renting it consistently, reporting the rental income on your tax returns, very, very important. That's key evidence, right? That cannot be hidden. And after a legitimate period of use as an income-generating property, income-generating producing property, it may become eligible for a 1031 exchange. This is one of those areas where talking to a CPA is a non-negotiable, as well as to the qualified 1031 exchanges companies in advance to make sure that everything is done and planned properly from the very beginning. What can you exchange into on 1031 exchanges? Another common misconception is that you have to exchange into the same type of property. The answer is absolutely not. You can exchange your vacation rentals into another short-term rentals or long-term rentals, or they could be duplex, triplex, fourplex, land, commercial properties, and also a property in a completely different state. The key is, as long as it is real estate held for investment, it generally will qualify. It's that simple. Now let's talk about common mistakes that kill your 1031 eligibility, I would say. Well, it's probably 5 or 6 of them. So here's where people usually mess this up. When they do too many owner stays, renting at deep discounts to friends and family, okay? Treating it like a hybrid personal home, missing that 45-day identification deadline of a new home, missing the 180 closing deadline. Those 45 days identifying a new home and closing the new property 180 days. Those are very, very strict guidelines. You miss that, definitely 1031 exchanges off the table. And also, I would say not using it as a qualified, not using a qualified intermediary for a 1031 exchange that guides you through the process, that keeps that those funds in their own escrow account, that money never touches your account. Very, very important. And a lot more to cover is in a particular session in the future. The rules aren't that hard, but most people just don't know them until it's too late. So please ask for proper advice and you are going to be fine. In closing, a 1031 exchange can be one of the smartest, I know it is the smartest tax strategy for building real estate wealth. But in this case, we're talking for vacation rental owners, but only if the property is set up correct. If your short-term rental truly operates as an investment, limit the personal use market rates, fees, keep clean and documentation trail, the IRS generally will always give you a green light. When handled properly, the 1031 exchanges will help you upgrade your properties, build your portfolio, and build that long-term wealth that many real estate investors are taking advantage today and have been doing it for years. All while keeping more of your money working for you instead of going to Uncle Sam. That's a beautiful thing, right? So if you need help navigating title, questions, details, closings, or investment property transactions, we work with very experienced investors and short-term rental owners. We are short rental owners ourselves too. And also work with people that really are experts of 1031 exchanges. And as a title company, we make the process smooth, fast, and stress-free. That's why we're here. If this was helpful today, I ask you to press like, subscribe, and we'll see you in the next one. Thank you for listening.